Okay, today is July 16th. Thank you, everyone out there, for joining us again on the Anderson Report. We are going to do a recap of today's action, little bit on a couple of earnings reports. And I am Tim the Source Anderson. If you have not yet subscribed to the YouTube channel, it's The Anderson Report on YouTube. And on Periscope, it's TJ Anderson 12. My Twitter handle is TJ Anderson 1. The Periscope account is slightly different. I can't remember exactly why, but it's TJ Anderson 12 on Periscope. On YouTube, it is the Anderson Report. Hi, Jen. Thanks for joining us. And you know what? We're going to mix it up a little bit tonight, and we're going to start with Netflix earnings, which reported after the bell. Netflix is obviously a big focus stock for NASDAQ. It has been a stock that has had considerable attention since the coronavirus lockdown started. A lot more people streaming, a lot more hours every day, and it certainly showed in some of the metrics for their report. Um, so let's go over what they reported and what the stock is doing since then and why. They reported shortly after the bell, probably by 4:05. The report was out. They had earnings of 6.15 billion. The expectations were for I'm sorry, they had revenue of 6.15 billion. That was a little bit better than expectations of 6.08. Their earnings per share were quite a bit light. They were at 1.59 earnings per share, $1.59. The expectations were for $1.81. I'm not sure exactly why. I haven't really dug into it. The only other thing I have to mention for compliance purposes is anything I say about Netflix, it's not a recommendation to buy or sell the stock. It's purely a recap of what their earnings were and a little bit of a insight as to why the stock is doing what it's doing after their earnings. So anytime a company reports, the investors are always going to focus on their revenue, which they call their top line, and their earnings per share, which they call their bottom line. So they beat on the top line, had revenues of 6.15 billion. That was a little bit better than expected. They missed on the bottom line. Um, they made $1.59 a share. The expectations were for $1.81. I would imagine that they had some additional expenses involved, but I did not dig into the specifics of it yet. Now, they gave guidance, which is the other thing investors will always look at, for next quarter's revenue to be 6.3 billion, and they gave guidance for next quarter's earnings to be 6.09 billion. Now, the other thing that investors are always going to look at with Netflix is their subscriber numbers. They gained over 10 million new subscribers in the second quarter. That's an astronomical number. Okay. The expectations were for them to gain about 8 million. So clearly, a lot more people at home in the second quarter, a lot more reason to watch Netflix if you haven't had not been a subscriber, or a lot more reason to watch it a lot more hours during the day. Um, Now, the the stock is actually was down about 10% as recently as an hour ago. I haven't checked it in the last hour. The stock had gone out at $527 just before the close at 4 o'clock. Just to put it in perspective, in September, at the end of September last year, which is about 7 or 8 months ago, the stock was $250. So it's more than a double off the lows of last September. and it closed 2019 at $330, and the stock probably was around the 280 level, or probably traded as low during the sell-off initially when everything went down, a little bit below 300. So it's definitely up significantly from where it was early in the year. It's been one of the big drivers of in NASDAQ of what I've called the internet traffic trade. But it is down about $50 after hours, or about 10%, trading around $480. Okay, why would that be? Well, they gave very conservative guidance. And sometimes it's very smart for companies to do that. Companies like to set the bar low so that when they actually report their number next quarter or next year, they can beat what the expectation or consensus is, or they can beat their guidance. And then that will be a positive headline for them. Now, the other thing that they said was they expect new subscribers in the next quarter to be 2.5 million. So, where they got 10 million additional subscribers in the second quarter, they expect new subscribers in the third quarter to be an additional 2.5 million. Now, some skeptics of the stock may say, oh, look at that. The growth is slowing. Well, obviously, if you're a company like Netflix and you just gained 10 million subscribers during in the quarter where the economic shutdown was almost in place for the entire quarter, that's a number that you're just not going to be able to repeat. Okay. And some people may have been a little bit bothered by the fact that they missed their earnings per share number for this quarter. I really am not totally up on whether or not they've had their conference call yet. With a stock like Netflix, what they say in the call is always going to have an impact in the stock price after the initial details on their earnings and revenue hit. Now, just to put in perspective, that number of plus 10 million new subscribers for the second quarter, a year ago, they gained 3 million subscribers in the second quarter. Okay. So I'm sure that massive jump in their subscriber base was due to the economic shutdown, which of course is not going to be nearly as extensive in the third quarter as it was in the second quarter. And they have a fairly conservative estimate for new subscribers of plus 2.5 million. That's just and their estimates for revenue 6.3 billion. I think that um, they are giving conservative estimates. It's a little bit like um, sandbagging in golf, okay? Or it's what you might call in the investment business or in Wall Street under promising and then overperforming. Okay. When Microsoft was going through its big growth surge in the 90s, it would set its expectation, it would set its guidance very low all the time for the following quarter and the quarter after that, knowing that they then had a very good chance of beating what their guidance was. And and that's and that's almost like a golden rule on Wall Street: under promise and over deliver. It's almost exactly the opposite of what politicians and people in Washington do. Politicians and people in Washington always over promise and then usually not only under deliver, but don't deliver at all. On Wall Street and for companies that have shareholders and giving guidance for their earnings reports, they always want to under promise and over deliver. Okay, that was Netflix. Now, let's go on to the economic data today. There was quite a bit of it, kind of a mixed bag, and the market really handled it pretty well, especially after a very strong two-day rally. So we started out at 8:30 with the highly anticipated weekly jobless claims and continuing claims number that everybody has been focused on every week since we uh, began to rebound a little bit off the economic shutdown. So weekly claims came in at plus, these were first time jobless claims, plus 1.3 million. That was down just fractionally from 1.31 million the prior week. Frankly, I think the number is a little bit disappointing. We really want to see that number get down under a million a week, and obviously even much lower than that. But it just shows that after the progress that we've made in the economy and the progress that the market rally has forecast, this employment picture is it's really a hurdle to make significant progress from even from the surprisingly strong jobs number that we had for both the month of May and month of June. Now, the continuing claims number did decline to 17.3 million from a number that was revised lower from it was revised from 18 million to 17.75 million, so 17 and three quarter million. I think the revision to the downside is a little bit of a positive. Anytime you see revisions to numbers, big numbers on the economy, going, the direction of the revision usually is a nice leading indicator of whether we should see improvement in that number going forward or not. But even that being said, we really want to see that continuing claims number down well below 15 million, even toward, somewhere between, at least somewhere, hopefully between 10 and 12 million by the end of the third quarter. These are people that have filed weeks ago that are still filing. We want to see a lot of those people go back to work. Maybe it takes the elimination of the $600 a week extra employment kicker from the feds to roll off at the end of July before a lot of those people go back to work. But also, we need to get large portions of the service economy to get kicked back into gear and get beyond its their 50% um, capacity or whatever capacities they're at. Okay, so we also had some other economic data that was more positive than the employment report. The June retail sales number was plus 7.5%. X autos, they cut the autos out because autos can skew the number a big, the high ticket item, was plus 7%. The consensus for both of those was plus 5%. Now, let's keep in mind that that came after the May retail sales number was revised upward to plus 18.2% from what was plus 17.7. That's an upward revision. So that tells us probably that this retail sales number is going to continue to improve. And um, just to be clear, that 7.5% on increase for June retail sales comes on top of the May retail sales number of plus 18%. So the monthly retail sales number is a sequential number measured from the immediately prior month, where like corporate earnings are always measured when companies announce their second quarter earnings. It's versus second quarter earnings a year ago because different quarters of the calendar have a different effect on companies' revenue picture and profit picture. So, but the retail sales numbers are sequential versus the prior month. So obviously the May number, which was plus 18%, was coming off April, in which we were totally shut down. We were starting to reopen a little bit in some parts of the country in May. So the retail sales still went up, still beat expectations, but didn't jump off the prior month as strongly as the May number did. We had the Philly Fed Index, a little bit better than expected, 24.1. That number was soundly in negative territory in March and April. And we had a housing index confidence number come in at 72. The expectations were 60. The prior month was 58. Housing is probably one of the brighter spots of the economy, especially with mortgage rates being at or near just an incredible all time low. 30-year mortgages below 3%. Okay, so that's pretty much the economic data. Now let's take a look at what the markets did. And let's just put into perspective that we came into the day after a very strong 2 day rally where the Dow had rallied 3%, the Russell 2000 rallied 3.5% alone on yesterday. The S&P had traded at its closed at its second highest level since the big sell-off began in late February. The Nasdaq has been off of its all-time high from last Friday, and certainly a little bit of steam has come out of the Nasdaq. We've had some of that extreme outperformance has shifted into maybe a couple of other sectors, and we also had the negative headline coming in today that the Shanghai Composite, which had had a very strong rally the first 7 or 8 days of July, was down 5% yesterday. Their GDP actually improved in the second quarter. It was up 3.2%. But their retail sales for June were down 2%, where a lot of expectations were that that number was going to be positive. So the Chinese market had negative data coming into today. Their trading, which was overnight for us, their market went down 5%. At one point in time, we were looking to be down much lower than where we started the day and where we actually traded at the end of the day. And I think that the market was held back a bit by the weekly jobless claims numbers, which I felt were a little disappointing. But the Dow lost 0.5%, not too bad after gaining 3% over the prior 2 days. The S&P 500 lost 0.3%, really just a fractional loss. With that, the S&P closing at 3215 is still its third highest close since the market started to cascade to the downside in late February, when it became how evident how severe the coronavirus might be. Nasdaq Composite was down 0.7%. The Nasdaq went out at 10,475. Again, midday, the highs for the day of the Nasdaq on Monday were 10,800. Okay, so some of the steam has come out a little bit of some of the real high flying mega growth stocks in Nasdaq that were responsible for the really overextended hyperbolic move that the average had the third time it got through 10,000, when it shot up to 10,800. It went out today at 10,473. Just as an example, Amazon, which traded above 3,300, I think close to 3,400 intraday on Monday. I saw it today, late in the day. I'm not sure exactly where it closed, but I think it closed below 3,000. I saw it trading around 2,950. So I'm certainly not saying you should buy or sell Amazon at these prices. I'm just pointing out that the stock was a double off its lows from March, and some people are taking some well-deserved profits in it. Now the Russell 2000 was down 0.7%. The Russell was up 3.5% yesterday, and it was only down 0.7%. Still went out at 1467. The 1450 level is a big level on the chart for the Russell. I kind of really want to see it hold that 1450 level, maybe take a run at 1500 on the next rally. And really these declines by the market averages were very moderate and very modest. And actually the breadth and the internal numbers of the market, what we call the advanced decline numbers, were actually even a little bit better than the averages. Now, keep in mind that yesterday, the advanced decline numbers, which is the number of stocks that went up versus the number of stocks that went down, on the New York Stock Exchange, there were 5.5 stocks up for every stock that went down. I think so the advanced declines were like 2,550 to like 480 going down. Even in the NASDAQ market yesterday, the advanced declines were better than 4 to 1. Okay. So today, the New York Stock Exchange had a little over 1,300 advancers. It had 1,600 decliners. So that's like, you know, only by 250 to 300 issues, decliners led advancers. That's almost kind of an unchanged day. Again, the S&P 500 was only down 0.3%. And even on the NASDAQ, which was down 0.7%, the broader NASDAQ, close to 3,000 stocks, over 3,000 stocks, you really only had 3 stocks decline for every 2 that went up, which supports the fact that the Russell held up pretty well because you're getting into a lot of smaller cap secondary stocks that I think some people that maybe have had a really good run in the mega cap tech stocks that have been driving what I've called the internet traffic trade, people are shifting out of that. I think they're shifting assets from there to some smaller cap sectors and maybe some stocks that they think have are oversold, overlooked, haven't participated in the rally to the extent that the big cap stocks have. And that's really a positive sign to see the market broaden out like that, especially on a day when you had very, very strong advanced decline numbers. To really only have like moderate declines on the market breadth is a pretty positive factor. And that's what we call really market rotation. When that's why I titled this broadcast "Rotation, Rotation, Rotation." Obviously, in real estate, if anybody's been a real estate broker and those people that are real estate brokers, the golden rule in real estate is location, location, location. And in the stock market, for a rally that's for a market that's had a very strong rally in the major indices, driven by 2 or 3 key sectors of the market, at some point in time for that rally to extend itself where you can consolidate the gains that the big mega cap tech stocks have had and some of the other sectors probably, and have the market, you know, go sideways a little for a little bit while a couple other sectors take leadership of the market. That's what we call sector rotation. So for a market to transition from a big, strong move off the lows to then a more extended move higher, you need more leadership than just 12 to 15 mega cap tech stocks that have been driving the internet traffic trade. And we have seen that with the sectors in the S&P that have outperformed. Today was a good example of that. Materials gained 0.5%. That would be like either raw materials and even paper product companies, chemical companies, basically anything that's used to make other stuff. That would be materials up 0.5%. Consumer staples up 0.2%. Industrials held their own in a market that was down. They were flat. And electric utilities actually did well, up 1.3%, maybe a little bit of money that's coming out of the high flying tech names being put into a more defensive sector with some yield, with bond yields still very low. I'm sure the yield on the utilities is a couple of 2 or 3 percentage points higher than the 10 year. Um, so the uh, underperforming sectors again, infotech, that's your internet traffic trade, down 1.2%. Real estate down 1.2%. And keep in mind when the real estate sector of the S&P 500 does not mean houses and home building, home builders, or things related with home improvement. That sector has actually been good, uh, very strong. The real estate really means REITs, which is uh, big office buildings, shopping malls, strip malls, industrial parks, et cetera, et cetera. A lot of those are structured as real estate investment trusts. They call them REITs. That's basically what the real estate sector of the S&P 500 is comprised of. Obviously, a concern about occupancy in big apartment buildings in urban areas, big office buildings in urban areas. Shopping malls has been an issue for a few years, and anything in a REIT structure that it involves occupancy from people working other than at home, there's a little bit of a concern about. Energy down 0.5%. Oil prices actually held up fairly well, still above $40, but the stocks are going to meander as long as oil continues to trade 39.41 or 38.42, whatever the near term range is, with 40 kind of being a demarcation line. Energy stocks are going to be very selective in terms of which ones underperform and overperform. The overperformance is going to come from the names that are lower cost producers. The underperformance is going to be from the deep water drillers and some of the shale companies that have a higher cost of production. So that was kind of a lot. Tomorrow, we do have a couple pieces of economic data worth looking at. We'll get data on housing starts and building permits. I would expect that those numbers would be pretty strong. A lot of the data that we've seen on the housing, home building, home refurbishing, anything related to home improvement or home buying, home building parts of the um, economy has been acting pretty well, particularly with talk about a lot of people looking to move out of big cities and mortgage rates being extremely low. We'll also get the first look at the University of Michigan Consumer Confidence number for July. It's expected to come in at about 80, a little bit of a bump from last month. We'll see if that really does show an increase, given the concern with some of the targeted shutdowns or targeted stalls in the economic reopening that we've been hit with over the last week or two. So that's pretty much I have. That's pretty much all I have for today. I think that the market has had a pretty constructive week this week. It's unless a route comes out of the blue to the downside, it's going to be a strong up week for the market averages. The Dow is closer to 27,000 than 26,000. The S&P is holding above 3,200. The number to watch on the S&P 500 is 3233. We get a close at 3233 on the S&P 500 cash. That would be above the close from early June. Okay? We're not too far from that level. The Dow has still got further to go to get above its early June level. So there will not be a lot of earnings tomorrow. It's a Friday. There'll be a few. I probably won't do a video tomorrow. If I do it tomorrow, I'm going to do it at 5 o'clock, not 7 o'clock. But what I did last week, and I kind of liked it, was I did an 11 o'clock Saturday morning. I might try to move that up to 10 o'clock. I just like to do kind of a week in review after I get weekly performance numbers on all the sectors, kind of to give people that want, and I know it's Saturday morning in the middle of the summer, a lot of people won't watch it live, but if you want to watch it after the fact, I like to do a weekly recap on sectors, the strongest sectors of the S&P for the week, just since we're very early in the third quarter, very early in the second half of the year, and give people an idea what big dough investors are favoring as we start the second half of the year. Big Fish, thanks for joining. It's great to see you in here. Same with Maddie and Jen Lavalette. I really appreciate the support from you guys. Um, I'm sure you've subscribed and liked the channel. If other people are watching, if you haven't subscribed and liked the channel, it's The Anderson Report on YouTube. It's TJ Anderson 12 on Periscope. My handle is TJ Anderson 1. I'll probably have some market updates early in the morning on there. Everyone, have a great evening. And if I don't talk to you tomorrow, have a great Friday. Thank you very much.